Hello everybody, this is David from ripetrade.com, and today I'd like to demonstrate with a short video the very basics of how to develop a quantitative trading strategy. The first step is you need an idea that you can quantify. In today's example, we'll use a very simple moving average crossover system. We'll buy the S&P 500 if the close is greater than a 10-period moving average. So we'll write the rule. If close is greater than moving average, close of 10 days, we're going to long entry buy at the market on the next day. Okay? Small error there. If close is greater than the moving average, 10 periods, we're going to buy at the market. And then for the exit, we're going to sell if the close is less than the moving average of 10 days. We're going to long exit sell at the market. Okay, and then what we are going to do is test this strategy on a chart to make sure that our code was written correctly and it looks like it's doing the right thing. You can see this blue line here is the 10-period moving average. Okay, so right here the S&P 500 closed above the 10-period moving average. We entered with a green triangle here at the market the next day after that happened. And you can see here all these closes are above this blue line, which is a 10-period moving average, until right here. The S&P closed below the 10-period moving average, in which case we sell at the market the next day. Here again, green triangle enters us into the trade, and the hollow red triangles exit us out of the trade. Now let's test this with the software and see if we could have made any money following this concept. Okay, looks like we would have lost a lot of money. Only 36% of the trades were profitable, and this is performance report is based on trading 100 shares of the spiders per each trade. This is what the equity curve looks like, and this is the trade history. You can see that this was from when it says 1989, which is when the spiders first started trading, to present. Looks like we would have lost a lot of money here. Okay, now we ask ourselves, maybe the 10-period average is not a good one, but maybe there's a better one. So what we're going to do is we're going to go back into this strategy, and we're going to change this 10-period to an X, which we can then make X equal a range of numbers. For example, a 1-period moving average to 250-period moving average. We could also just arbitrarily, say, hey, the books talk about a 50-period moving average working. Let's give that a shot. But this way is a lot more effective, and you can cover a lot of ground in a short period of time by just running one of these optimization reports. So we're going to make the X equal 1 to 250 in steps of 1. So that means it's going to test every moving average crossover from 1 days to 250 days. And this is what you call an optimization report. Right now, these are all the strategies being sorted by total net profit. See, this L1 column is the period, the moving average period that's being tested. Win percentage, number of trades. These are all your performance metrics. So for the best moving average crossover system based on total net profit, 234 days is the best strategy to follow there. Based on profit factor, which is an important metric that many systems developers like to use, the 249-day crossover is the best strategy to follow. So if you see, if we go ahead and sort this strategy again, this optimization report once again by total net profit, we could see that these longer period moving averages tend to make the most amount of money. If you buy when the S&P 500 crosses over a long period moving average, such as a 209-day period moving average, or the most optimal, the 234-day moving average would have made you the most net profit over the long period of time from 1989 to present. And these shorter period moving averages would have lost you a boatload of money. That's it. This is David signing off from www.ripetrade.com. Hope you enjoyed this video.